The medical professionals in general have very quirky tax rules. So we've actually created a separate division to service our medical professionals as well as the accountants that work in the divisions, especially trained to work for medical clients as well. The relationship with an accountant is a relationship based on trust. As you kind of open up with your finances and other things as well, your accountants tend to know a lot more about you than sometimes your own spouse might know.
No, I think it's just important to engage all of the professionals in all their different fields to make sure that you're being strategic and you're planning ahead and you're not putting all your eggs in one basket and not thinking forward. If your goal is to buy 10 properties, we need to talk about that now and not in 5-10 years' time.
If you want to have a big property portfolio, have a talk about it today, not wait until you have no more borrowing capacity. Hi everyone, welcome to another episode of the Investing for Doctors podcast. I'm your host, Dr. B. And today we have two guests with us today and from two different sort of profession groups. All right. First, we have Nafees Huda from KHI Medical.
Hello, B. Good to be here.
Awesome. And we have Alyssa Charles back with us again from our mortgage broker team.
Thanks, B.
All right. So because you're new, Nafees, why don't you give us a little rundown of who you are, how you got to where you are today?
Sure. Absolutely. Thank you. I've been in the industry. I started off in commercial, actually, for a couple of years. Then I realized, working for a company in finance is not my thing. I wanted to kind of help people out by solving their problems. And that's when an opportunity came up to join Bell Partners, which was one of the most productive accounting firm in Australia at that time. That was about 15 years ago. Since then, I've worked at various large practices, RSM, Burt Cameron, to name one of them. And then in 2022, I actually got an opportunity with mid-tier practice to join as a director for their business advisory division. And just at that time, I met Mazrul at a function, and we got talking, and our visions, the way we do our work, our clients, and our objectives in life balanced up, or it matched, right? Yeah. So Mazrul's like, "Why don't you come in and have a chat?" So next day, went into the office, and 1 hour chat ended up being a 4-hour conversation.
So he recruited you, basically.
Pretty much. It sounds like that way, right? Yeah. So so I had no intention whatsoever, because my mind was set, I'll go climb the corporate ladder, in a large tier firm. But I think it's probably been the best experience of my life since I've joined KHI, because it's not just the work itself, it's the type of work we do, right? As you can see under KHI logo, contributing to your life, right? And that's something I truly believe. Making a positive contribution to people's life by improving their financial abilities, and also protecting their assets for the future generations as well.
Okay. So, because you haven't mentioned it, you are an accountant by trade.
I am an accountant. I'm a chartered accountant. Yes. I do have my bachelor in business and commerce degrees, and then I have done my CA program as well. So I've been a chartered accountant for almost 10 years.
Yeah, beautiful. And I guess you're collaborating with, working together with Mazrul.
Yes, that's right.
KHI Medical.
That's right. So KHI Medical, both Mazrul and myself are partners in that entity. So we do have a team behind us in the background as well, about 8 to 10 staff. And the reason why KHI Medical came aboard, because the doctors have, the medical professionals in general have very quirky tax rules, right? And of course, PSI, just to name one of them, or the structures and companies and certain ways, even for practice owners, it's a little bit different than a normal day-to-day business owners, right? So we've actually created a separate division to service our medical professionals as well as the accountants that work in the divisions, especially trained to work for medical clients as well.
Awesome. I think that's quite a good summary of who you are, where you come from. So, and Alyssa, I think you've been here a few times, so just a quick.
I'm a finance broker, and we've also partnered with IFD to be the lending partner, and I can vouch for the holistic services provided by KHI, because we have been clients of theirs for a few years now. Yeah. And they have really just looked ahead and looked at our long-term goals and completely restructured our company for the better good of us in the long run. So amazing.
Beautiful. And so welcome, both of you. Today's episode, we're going to focus on more from a lending approach, but also on how an accountant can assist in that process. Because on a previous episode, we talked about, speak to your accountant, your accountant will give us the numbers. And we want to, have that focus on sort of structuring, because that's what accountants do best. They are very good at structuring from a tax, cash flow, P&L's perspective, and how we can marry the two professions to derive the best outcome for your clients on the together journey. So I guess the first things first, from a property and lending perspective, I would say, as a doctor myself, probably one of the first few loans you're going to get it under your own personal name. And that's quite straightforward, isn't it?
Yes and no, right?
Yeah.
It can have the answer can be both ways. It depends what your goals and your objectives are, right? So when we do speak to a client for the first time, we always start off by taking a snapshot of their assets and liabilities, and then we speak to them about their goals and objective. What are you looking for in the next 5 years, 10 years, 15 years, right? And whenever we speak to someone, we always go with the mindset of how we can service you for the next 30 years, right? And by having that 30-year horizon in front of us is that, as an accountant, we cannot do anything wrong, number one, because we're not here to do your tax return for a year or two. It's how we can kind of add value to the rest of your life to get you to your goals, right?
Yeah.
And by doing that, we kind of take a step back and look at the whole thing as an overall approach, right? It's not just an accountant that's in the picture, right? You need a specialized mortgage broker as well. You need a financial planner alongside as well. So there's different, a good lawyer as well from the legal perspective. So it's good to have a good team behind you, right? Yeah. In terms of your questions, whether borrowing as an individual, initially, look, yes, but that depends on what your goals are, right?
Yeah.
If your goal is to be an investor and have a portfolio of properties or other investments, it's good to kind of take a step back and work with the mortgage broker to see, look, this is your, borrowing ability. What are the advantages and disadvantages, individually or in a structure, and then take a step back and approach it. But in most cases, yes, it is, to start off a couple of properties individually, because number one, you get the disadvantage from a structure, which means the land tax threshold, right? And also the tax advantage as well, as you've mentioned, right? The negative gearing, you can really capitalize on that as well.
So I guess from a lending perspective, it's obviously easier to lend in name. It's cheaper to lend in your personal name.
Yeah, it is a different scenario. And I think it also comes down to deposit, because if you're purchasing within a trust or a company, you need a much bigger deposit. So, often the very first purchase might be a 95% purchase. So really your only option in that situation is to purchase in your own name. But yeah, like Nafi said, we will talk to the person and the borrower around what is your intention. If they don't plan to expand a big portfolio and they just want a home loan and an investment loan, there's probably no need to go through the cost of setting all that up.
So I always like to use hypothetical examples and these sort of things. I'm, say, 35. I've got my own occupied. I'm starting to look at investment now. And say I've got a borrowing capacity of, say, $3 million. But I've got wild ambitions. I want to own a $20 million property portfolio by the time I retire. So what are your thoughts on that?
The very first thing I would say, I would explain the benefits of setting up a trust. And I would always say, do you have an accountant who is good and you trust? Yeah. And, often they do have someone they work with. And I would then often, if it's not you guys, we would set up a meeting with the accountant to talk about this potential strategy and the costs of setting it up and the tax advantages of setting it up, and because it's not cheap to set up a family trust.
There's a cost factor to it as well.
There is. But yeah, I would always get the accountant on the call for this. We don't give structuring advice. I can tell you what we can do for you, but we always have to be guided by what the accountant would recommend.
In that scenario, at some stage, you will need to utilize structures without a doubt. That's unless you personally bring in $5 million, then no one's going to really say too much. But to get a $20 million property portfolio, you're going to need structures and ways to increase the serviceability for the bank to lend you enough money to achieve that, I guess.
Yes, but it's not as easy as it sounds. To go back to your example, you're 35 years old, right?
Yeah.
My question firstly will be, okay, are you under PAYG or do you work as a sole trader? Or do you work through a structure mechanism, right? Yeah. For example, in the medical professional, there are many general practitioners as well. They operate through a trust structure. They already operate through a company structure. Also, a lot of them are as an individual sole trader structure as well, right? Yeah. So it really depends on what structure you use, number one. Number two is that what is your goal? As you said, you already have a wild ambition to develop a $20 million property portfolio as well. Of course, I have to be careful that I cannot give financial advice as an accountant, right? But at the same time, is that what I would probably do is that I would go back and look at your current portfolio and to see what you have in your current portfolio. Then I'll probably get Elisa involved in terms of having a look at the total borrowing ability. Yeah. Because one thing you need to keep in mind as an investor is that each individual, based on your current income, has a limited borrowing capacity, right? Yeah. So it's really important to have a gap left in the current borrowing capacity in order for you to borrow in other structures, right? Yes. I know it's a bit of a trend these days with, there's so many videos and, podcasts and other things where, buy in a trust. And, we do get a lot of clients that comes into us saying, oh, we heard this podcast. I want to buy the property in the trust. And sure, that's good enough. But what does it mean, right? And then when we have a strategic mortgage broker involved in this thing, because the difference between a strategic and a general mortgage broker is a strategic mortgage broker can future plan things, right? Yeah. And as a strategic accountant, we also future plan things. So we kind of go back to the drawing board and look at what's left. Right?
Is that a new buzzword? Is that just be strategic about everything?
It is a little bit, yeah.
It is. It's important because there's not many people out there that does this kind of things, or that, that's right, that are forward thinking, right? So it's important for us, right? Exactly. And now, and I'm sure, people have heard Manzurul in the past as well. We see ourselves as a strategic accountant rather than a transactional accountant, right? Anyone can do a transactional accountant based on the past, right? But where we look at is that we look at the future, where you want to be and how we can assist you, or the team can assist you to get you where you want to be. Right.
Excellent. So I'm going to add some more information into this scenario. Say I'm a gastroenterologist and I'm a sole trader right now. I'm working through, my mate's clinic. I bill $1 million a year and I take home 700, for instance, of like net.
Well, the banks uses this thing called, there's two things. Number one is your serviceability. They look at. Number thing is that it's your DTI as well, debt to income ratio. So basically, on a high level, correct me if I'm wrong as well. So it's more of a Lisa topic, but on a high level, the bank takes your total income. And then they take a portion of your overall rental income as well, percentage of it. They add it together and then they have a multiplier of could be anywhere at the moment 4 or 5 times, right? Yeah. So that's a DTI. So that kind of works your borrowing ability, right? And then you look at the servicing, right? What are your spending habits, right? Do you have an expensive lifestyle? Do you like to go out and splurge a bit, or how you, because banks look at these things and they have a big impact on your borrowing as well. Another thing is that where I had with one of my client is he had a clean record of very low expenses and all that, but when the bank went to look more deeper into it, they realized that he had some unpaid electricity bill. And then when we went back, is that because he moved home from his previous home to his new place, he did not change the utilities bill from his old property to the new property. Therefore, there's about 6 months of, that's right, default 6 months of unpaid electricity bills. So we have to really be on top of our utilities bill as well, because I have seen how it affects someone's borrowing ability as well from it.
Okay. But I mean, okay. So let's say this guy's clean. He's got his owner occupied, which is, say there's still $1 million loan on it and it's like fully offset. This is like a dream client. Yeah. So we now need to start thinking about, okay, he wants a $20 million portfolio. At what stage do we start getting the structure? Do we do it now, or do we say, okay, you still got enough capacity for borrowing, let's do one or two more before we get?
The question comes into, it's not just about borrowing and building a portfolio. It's about protecting that as well.
Yes.
And how you can pass on those property to your future generation. Right.
Yes.
Of course, after you have got, a couple of property, chances are you'll be capped to your land tax limit, number one.
Yes.
So you will not get that advantage as well.
Yeah.
Secondly, is that, of course, your borrowing ability as well, you need to have a bit of a gap as well. So maybe at that time, that would be the right time to look at structure, borrowing through a structure.
So what you're saying is that for me, let's say I was that person. I could still borrow in my personal name or my spouse's personal names until we start hitting the land tax threshold, depending on how much both of us have.
That's right. So each person, if you have a joint property together, then there's only one threshold. If it's one to each, you reach the threshold as well, right? But at the same time, you need to make sure that, okay, look, if your goals is to grow your portfolio, you already have a couple of properties under your individual name, as you have said. In that case, I would probably get the next ones. Might be better for you to look into other structures. Yeah. The reasoning being, of course, there is a borrowing ability as well, because your goal is not just to have one or two more property. Yeah. You said you want a $20 million property portfolio, right? So now my question is that, Lisa and myself will kind of sit down together and we will work out exactly what the borrowing ability looks like, not just for the next property, but based on your income level. Let's just say we projected, a little bit of a growth over time at a certain percentage, what you need to get the next 1, 2, 3 properties as well, right? And that's important.
Exactly. And I guess in that situation, whether you're getting a higher yielding residential property is going to be quite important.
That's what I was going to say.
And the kind of properties is going to...
Yeah. So when the idea of purchasing within a trust, for example, is that you want that property to look after itself. That's the end goal. So if the income of the property is covering all the expenses of the property, and that can be wildly different depending on your rental yield. Yeah. So if you buy a duplex as opposed to a house, your rental yield could be double because you're having two rental incomes for the one property. So ideally, I think the end goal for this structure is that you want that entity to be quite neutral in terms of its covering itself. And once it's at that point, for future borrowing, that is sort of separated as its own entity. And some lenders will leave that loan and that rental income off your whole servicing position altogether.
And can that structure be in a trust, or does it have to be in a company, or it doesn't really matter?
It can be many things as well. Just to add on a little bit more towards what Elisa just said, yes, a property would need to be positively geared as well. But to generate an income from a residential property is not always it's easy, because number one is that current interest rate is about 6.5%, right? And then you've got your maintenance and running costs, which is another, say, 2 or 3% of the overall value of the property. So there's a 9% outflow, and then so that means your rental yield would need to cover that 9%, which is high. That's why you need a very your LVR, the deposit to purchase a property, has to be higher in order for you to achieve that, number one. But at the same time, there's many people ask me that, what if I take money out of my equity in my personal name and put it in the offset account in the family trust? Well, that's not really the right thing to do, right? Because you're not portraying the right picture or painting the right picture, right? So it's important to have that right level of LVR in order for a property to be positively geared. Yes, there are certain properties, as you've mentioned, right? Duplexes and other things that yields a higher rental, or maybe, house with a granny flat, right? Yes. Because suddenly the yield increases, right? So, as an investor, it's not about just getting that investment property. It's that type of property that add value to your overall growth as well. How you can add yield, right? And that can be both for residential and commercial, as we always say, right? Adding a mezzanine in a commercial, for example, increasing the floor area for a commercial property, just like that in residential, adding a granny flat. Can you extend to add in another room that increases the value as well? So those are the things that are important to increase the yield.
Yeah. So it's not as simple as just getting a structure and then putting anything in it. It has to be the right property.
It's not, because an accountant would need to actually, with most banks, the accountant would need to sign off on a letter confirming that the property is positive.
Yeah.
The advantage of it is that when an accountant is looking at a property P&L, it is looking at the actual P&L. Where the banks are calculating their servicing, they use this buffering of 3%. On the servicing, there's a 3% buffer, right? So accountant, when we do the letter, we use it based on the actual facts and figures, right? So that's one advantage of that accountant letter. But at the same time, you need to make sure it portrays the right information.
Yeah, of course. Yeah. You can't lie about it.
Of course.
So then I ask a question. So if I had a trust that was getting, say, for instance, regular passive income through it, because I've got some shares in it that held dividends, that is going to the trust, can I utilize that to offset the interest repayment? Say, we add this 9%.
If you have, yes, absolutely. If the same trust has other incomes coming through it, you've got the money in the account as in the cash in the account. Of course, you can park it to an offset account. It's just that at the end of the year, if the trust is a profitable trust, it needs to be distributed. Yes. The income of a trust has to be distributed, right? The disadvantage of a trust, I don't think we've touched base on that, is that number one is the losses retain in the trust. So if the trust is negative gearing, you cannot offset it until the trust starts to make a profit, or you sell the property, the capital gains, you can actually offset it against the losses that's captured there as well, right? Yes. So it's important to make sure that we kind of plan it that way. But to answer your question, yes, any extra funds that you have, income you get generate in the trust, you can keep it in the offset account until the time of distributions. Then of course you have to distribute it to an individual, for example, pay the tax on your personal level or through a bucket company, whichever works. But if it's to individual level, you can lend the money back to the trust account again. Right? Because it's a contribution from the owner from a post-tax money.
So essentially the only way you can capitalize the trust is by obviously lending to the trust for deposits and that sort of thing.
That's correct. Contribute as much as capital towards the trust as possible, to make the leverage as low as possible. But at the same time, there's many other things as well, right? If it's a commercial property, for example, there used to be instant asset write-offs, in certain case. See, a lot of and Alisa, I'm sure you will agree with me, right? When it comes to lending, a lot of it is a storytelling to the bank, right? You need to paint a picture. Okay, you tell a story to the bank as to what are the touch points for the bank that are important, right? So, for example, you might have a set of financial statements where there could be depreciation, right? The banks can actually certain banks add back the depreciation.
Yeah, that was going to be my next question.
Right.
Well, depreciation is seen as a negative, right? It's a negative on the...
That's correct. It's a paper deduction.
Yeah, it's a paper deduction.
Another thing is that it's very important is that from a tax law point of view, you can declare your income on a cash base and then also an accrual basis as well, right? Yes. So the timing effect of things as well. Yes. So, by doing an accrual basis, for example, in June, you've invoiced some clients and customers for which you haven't collected the money, you can increase your income by that amount by taking that amount into the debtor, right? So that increases your overall income, therefore your serviceability as well. There's no one solution fit for every individual. It's how we have to sit down with each individual or business owner and to see what is the best way for them.
It's an accounting method.
That's right.
And, I've seen instances where a company would get a upfront payment, but it's for a service that runs over 12 months. They can either have it all upfront or they can amortize it over 12 months.
That's right. That's right. It's how you, I mean, at the end of the day, you still end up paying the tax. It's a timing issue, right? But what I'm saying is that we're a strategic accountant, and I'll keep using the word strategic because, can implement is that we can, portray the right picture, of course, in the legal way, but the way the banks wants to see, right? For example, bringing in the debtors, the creditors, as well as, depreciation, or there could be like, for example, your wage is about 150,000. Let's just say super guarantee is at 10%. You have $15,000 of a superannuation, compulsory superannuation guarantee that you have to pay, but you wanted to put in your maximum cap of 30,000 for that particular year. We can actually tell the bank, look, you know what, the actual obligation was 15,000. However, the client has made or the business has made a $30,000 super contribution to add back that 15,000, right? So these are the things that can be done to ensure the right picture is being portrayed to the bank.
Okay, beautiful. So even if you did, like I say, a voluntary, a non-concessional contribution, does that...
Non-concession is a post-tax contribution, so that's different. That's coming out of your own pocket.
Yeah, but they're not going to say that's an expense, would they?
No, non-concessional contribution, it comes from your individual. It doesn't come through a company. That's correct.
Yeah, beautiful. Now, there's a question to you is that we've heard all of that from Nafees, and as long as Nafees writes on the accountant certificate that the trust is self-sufficient, do you have to do anything else, or you just take that? Okay.
No, and look,
we'll assess it as is.
In some cases, the accountants don't want to write that letter, and in those cases, it's because it's not self-sufficient. So we really
it needs to be self-sufficient.
It does need to be, and it can take time for it to be self-sufficient, and I think that's one thing that
be based on future projection as well. I get that many requests. It's like, well, the rent's about to go up. We project it to be XYZ, but it's not about future progression. It's That's right. So that's important as well
to show that.
Yeah. So it is a bit sticky sometimes because there are a couple of lenders that don't want the letter anymore. So they will just accept that the customer has said this property is covering itself in this trust and that.
As in cash flow problems. You don't want to then get them this new loan, but then they run the cash flow problems.
That's right. So it's all, it's a really good strategy, but I think realistically you have to have a realistic picture on if you really want that to be self-sufficient, maybe you need to put in more than 20% plus costs, like a 60% LVR is probably a more realistic position to enter into, but a lot of people do 80 with the view that maybe for 5 years that won't be self-sufficient. So it's all case by case. But look, I think it's important, like Nafees said, to get the right property. And we always recommend anyone purchasing property, especially in this scenario, but in any scenario, buying an investment property, to deal with a buyer's agent and this a buyer's advocate. And this is becoming more and more popular.
Very, very important, right, to a buyer's agent, right? As Elisa has said, right? Another thing is that, say, in Perth during 2022 to 24, during that time, there are a lot of investors were purchasing in Western Australia, right? One can argue that Perth market has slowed down a little bit in Western Australia, or reached towards its peak. But at that time, that $400,000 to $500,000 property range are currently valued at $600,000 to $700,000 plus, right? And when someone gets into a property at $400,000 to $500,000 with a 4.5% yield or 4.75% yield, as the property prices increases, the rent naturally increases as well. So your yield on your purchase value will also increase over time. That also helps with the trust being positively geared as well. So it might take about 2 years, 3 years, 4 years time, but it can happen, right? So it's about planning, back to this thing, drawing board, right? How you plan each purchases, having a disciplined life as well. Of course, you're not going to be frugal or anything like that, but, have a disciplined life, to show that, you're financially responsible to the bank. That's basically what the banks want to see, right? Whether you're financially responsible.
From that trust side, once you've got that sign off, you can borrow more than to put into that trust, isn't it? As in, for instance, I already have a property, say a $1 million property in the trust. It's, paying itself off. It's self-sufficient. And the thing is that, okay, now I want to buy another one, but can I put that in that trust, or would that make everything?
Of course you can. Of course you can put it in the same trust, right? But the question is that it comes down to the same strategy and the drawing board as well. Is that what you're going to do? Because if one property is making positive and you add in a second property, then the entire portfolio might be negative.
And then, so if it made the entire portfolio negative, I will end up being assessed on both of the loans again.
It's what's in the trust as a one whole entity. That's right. That's right. That's right. So there's a couple of things we need to consider, right? Number one is, of course, there's a cost attached to it as well, right? The cost attached to it, of course, is a setup cost. There's the ongoing accounting fees, running costs as well, right? So we need to keep that in mind as well. At the same time, as you have just mentioned, right, having adding the second property could impact, push the trust into a negative trust as well, right? So is that what you want to do? Maybe, if you have a second trust, if one trust is positive, the other trust is negative, that income from the positive trust can actually be distributed to the negative trust to offset some of the negative anyway. That's not a self-sufficient trust, but I'm saying is that you're not paying tax in an individual hand. You can still distribute that income to another trust that has a negative income. So you kind of take advantage of that, the losses rather than being captured, you utilize it.
And in those situations, even though the entity, the trust is not self-sufficient, but then you're not paying additional tax on the trust distribution, and some of that is
on that income that is producing on the positive property.
And you're not losing out on negative gearing on that side.
That's correct. That's correct. So that itself is a strategy as well, right?
Yeah.
So as I said, there's nothing one picture that fits everyone, right? We've got one client, he's got about $35-40 million portfolio, about 90% fully paid off. He's got one property in different trusts. So he's got about 40 different trusts holding different properties. And what he does is that, and most of them are positively, it's an income producing trust. So he has one bucket company. All income gets paid into the bucket company, pays a 30% tax because tax rate for an investment company is different to a trading entity. So 25 to 30%. So pays a 30% tax on that. From the trust, maybe individually they get a little bit of a distribution just for them to kind of live through their retirement life or to cover their basic spendings. And the rest of them that gets captured in a PTY limited bucket company at 30%. Now, they can use that PTY company to invest in other shares or other assets or other property as well from the rental income, and that's also post-tax money as well, right? And that's when the question comes in of do you purchase it through a company or trust as well? Everyone's situation.
Yeah, exactly. Because once if you're a company, a bucket company, then into an individual, then into a trust, there's that the 7A.
That's right. I mean, from a company, there's three ways of taking funds out. Number one is pay yourself a wage, but that wage also has PAYG withholding as well as a super contribution. Second way is that pay a dividend. That's actually not a bad idea as well because the company has paid a 30% tax on that income. Pay yourself a dividend if you're in the top marginal bracket, right? And so you pay it in individual hand. Whereas in a company, you just cap it at 30% and you leave it there. And the third way of borrowing money is via a loan as well. Now, when it comes to purchasing a property and you're borrowing money from a company, it falls under Division 7A law, but it's not a 7-year loan term. You can actually get a second mortgage, registered mortgage, between your PTY Limited and your trust or your individual at a 25-year loan term with an interest rate that is set by ATO every year, which is the same rate as a Division 7A loan rate every year. But you have that loan thing. So you can actually borrow the fund from a company. If your company has enough funding to cover for the next purchase, you don't have to go to the bank. Your company becomes your bank. That's why sometimes we call it's a banking entity, the bucket company, right? So
I think we should have another episode about this concept of bucket company, and it basically becomes a family bank in a way. That's correct. Yeah, that's correct. And what's the prevailing 7A sort of rate?
Division 7A, this year it's about 8 point something percent because of course it changes every year, right? And it's a little bit higher than what the inflation rate is. Of course, the inflation was very high last year. Yeah. That's why it's 8 point something. Now that inflation's kind of pegging back a little bit, it might go down as well. But this is the highest I have seen in the last maybe 16, 17 years, what the interest rate is.
So the point I'm trying to make is that it's not quite the residential borrowing rate. It doesn't operate exactly off the cash rate.
That's correct.
Even though there is some correlation because the cash rate and inflation are symptoms.
That's right. From what it seems like is the cash rate plus the inflation together. And of course there's the ATO calculation on that as well.
Yeah. And so does that changes every year depending on the prevailing economic circumstances?
That's right.
So it basically means that I don't have a loan if I'm borrowing from my company.
It's like a variable loan.
It's a variable
loan.
Yeah.
But you know what the advantage is? You're getting the loan deduction on the individual name just like you would get as an interest deduction. But company on the same time has to pay tax on that interest income because technically you're paying the money back, right? Yeah. But you're saving at 47% where the company is paying a 30% tax. That's correct.
That's right. So that's right. Reverse.
That's right. That's right. So that is about tax planning itself as well.
I mean, that's obviously another strategy. And I guess the next part we should talk about is what if you bought your property in the company? Then you can directly lend from a company to company, and you could pretty much lend that interest free, can't you?
That's right. So it is ideal for business entities that are quite profitable and that has a lot of retained earnings and cash in a PTY limited, right? So the difference between investing through a company and a trust is that a company is taxed 30% flat rate if it's a residential. If it's commercial, it's treated as a business, it's 25% tax rate. Yes. Company do not get that 50% capital gains discount, where trust, if it's distributed to an individual, you can get that 50% discount as well. So you've got the discount effect, you've got the 30% tax effect as well. And so what you do from a company, if a company is profitable, so I've got this client, turns over about $25 million a year. The bank balance is about $15 million. Right. And, he called me up the other day in the face, I saw this property, let's just say value of $5 million in the Northern Beaches. I want to, it's an investment property. I want to purchase it. Right. Okay. He does have a family trust. Okay. So what do we do? Okay. You need a 25% deposit on that $5 million. So, based on the conversation with the lender, he needed about 1.5 to about $1.7 million in cash to fund that, right? So there's two options. Option number one was to company pay dividend via his family trust. He pays the top-up tax on that $1.7 million or $1.5 million for calculations. In fact, that's about almost $320,000, $330,000 worth of tax. You pay that upfront and then you on-lend it to a family trust, right? The advantage is that, okay, you can take the negative gearing, you can take the advantage of the capital gains discount, that 50% discount in a trust. Or the other option is, instead of paying the $300,000 in tax, you can lend the fund to another company. Loans between a company to company, there's no Division 7A because as of now, the rules. So if you lend the company that $1.5 million from company A to your company B, and then company B, given that the serviceability and everything, adds up the same way as it would in a family trust, that, company B can literally borrow the money and purchase the properties in that company B. Company B, any losses that it makes, it just stays in there, just like a trust. But however, as it starts to make profit, the profit doesn't need to be distributed. It can be capped at 30%. Exactly. So that's an advantage as well. And this retained profit in a company, you can give yourself, take dividend out of it in future. If you structure it the right way, if the shareholders are family trust, you can, push it to a family trust and give it to any other family members as well, below the tax-free threshold in the right age group as well, right? So that can be done as well. So it's a very good tax planning strategy as well and method as well. What advantage you have? You've got the $300,000 in the market that is compounding over time in advance. Yes, capital gains, 47%, 50% discount, you still pay 23.5% versus a 30% flat tax rate. So it's a 7% more you pay if and when you sell a property. Question is, do you ever sell an investment property?
But the lending side is different for a company, trust, and individual, obviously. So I think the more it is, as in the more complex the structure, the higher the interest is.
Well, I mean, yeah, borrowing within a trust or a company, there's limitations on LVRs for one. Like you can't go sort of over 80% for those. But yeah, I mean, essentially, no, you can still get reasonable interest rates for borrowing in a company. But yeah, commercial security adds a bit more of a premium on costs and things.
And so one of the other things that, you mentioned residential and commercial within a company. Obviously, if you have a commercial, it's 25 because that's a business.
It's treated as
a business.
That's right.
And I think if the percentage of business and the percentage of passive income within the company exceeds a certain ratio.
It's 80-20 rule that they use.
So
80-20 rule, but of course from a proper structuring method, if you have a portfolio of residential properties and a portfolio of commercial properties, whether if it's a trust or in a company, would like to keep it separate as well.
Right. Is there any harm in keeping it together?
Number one is that from a borrowing perspective, because they're all guarantors, depending who the guarantors are, who the directors are, so there is complications around it as well. Lisa, I'm sure you can explain a bit more. When it comes to having too many, it's the same thing we just talked about before as well. Concentration, number one. Number two, of course, the borrowing ability, the self-sustaining as well, right? Of course, in commercial property, there's two type of loans, right? You've got that full servicing loan as well as the lease doc loan as well. And then, when your lease expires in 5 years' time, when you go to renew the loan, right, it takes in all the other entities. So if you've got a negative gearing property in the same company, that's right, you may not be able to do it, right? So you need to have the right structure.
So there is pros and cons. So if you're thinking your structure is going to be hugely positively geared, and you're not going to run to that risk because, for instance, you have a $1 million share portfolio that is pumping out X amount of money that will cover that. And the shortfalls, for instance, I'm just making up.
Look, like I said, it's a scenario by scenario balance. Okay. We always take a balanced approach because one does not need to establish a structure if they don't need to, right? So we always work with what you have first, right? And then we go into the drawing board and we, of course, work with, Lisa, Eloise, and to work out what the borrowing scenario might be. And then we come up with the option for the clients. Look, option A is this, option B is this, option C is this. If you stick to the same structure as well, let them make the decision. As an accountant, we cannot tell them what to do, but we can present them different options and ideas, right? And let them decide as well.
Yeah. So we briefly touched about lease stock. So what's the lease stock?
Essentially, it's when you've purchased a property that's got a lease in place already, and it's commercial property, and typically the lease, you're borrowing at an LVR that is lower, and what the bank wants to see is that the rent will usually 1.5 times cover the costs of holding that property. So that's interest, expenses and things. But look, the outgoings are often covered by the tenant. So yeah, it's assessed in its own entity. So once again, it's good for people who might have serviceability issues. They might have you need a big deposit to put into those. So yeah, they do serve a purpose, but like you said, the lease term has to match the loan term. So once that expires, you'd have to basically reassess it and renew it and renew.
Sometimes you have lease, which is like 5 + 5 + 5 + 5.
That's right.
Then is that, do they look at 20 years or is that 5 years?
That is, if it's a 5 + 5, you have to go back to the bank every 5 years.
Oh, sorry, yes, No, So they usually, they'll just match it to what the lease term is, the loan term. So at the end of it, it will get
because it's an option, right? So I think at the end of the day, you have to go with what the bank dictates, right? The lender dictates. Whatever the lender wants is what you need to provide.
So probably at that 5 years, it will come as is the tenant renewing? Yes.
To redo it.
Certain banks might do that, as I said, it depends on lender by lender. Various lenders have different criteria and thing as well. One thing is that with lease stock, the interest rate is a little bit higher as well, of course, because the bank takes on a little bit more risk on a behalf. That's right. But also at the same time, it increases your serviceability as well, right? Because you're going to, allows you to borrow. From what I've heard is that, it can increase it up to 20% serviceability wise.
And this might sound like a dumb question. Can you do a lease stock under your own name? Like say if I'm, for whatever reason, I own a commercial property and I got under my own name and I got a lease stock on it. Would that sort of cover itself, or that's only within?
No, you'd want to put it in an entity because that's affecting, the whole purpose is to get that out of your personal name and your personal servicing position. That's an entity that will be sort of...
I think lending in a personal name is a lot more difficult for a commercial property. And of course, it's not advisable at the same time as well, because if you've got other incomes coming in...
Say it's done because this was my, say, I bought this practice, for instance, that's the property and I did it ages ago. Now I want to redo up the loan. Can I just do a lease stock on it? Or would that not be something that's really viable?
I think that's more of a lending question, right?
Actually, no, I'm not seeing lease stock in a personal name.
It is, but most people wouldn't do it that way. But
but in hindsight.
But I have seen restructuring situations like that as well, right? The restructuring is that
restructuring.
Restructuring is something that can be done as well. Like for example, I've seen many cases where an individual in medical practice owners where they bought it under their own name, or they had the residential property that they converted into a commercial practice, right? Exactly. So commercial practice, right? And then you've got that option as well, like, okay, look, you know what, to structure yourself better, can you own it in your in a superannuation fund? That's an option as well. Of course, you need the right financial advice to do that, right? But that's an option as well, to kind of selling your commercial your property into your commercial property into a superannuation, and have, of course, a commercial loan agreement, commercial loan, as well as a arm's length rental in place as well, right? Given that you meet all the rules and regulation, restructure is also possible as well. Of course, there's a capital gains impact as well. You have to be careful as well, right? But
it's basically a purchase. So yes, you would have to pay all the costs of moving it over, but if it means that it's getting it out of your whole personal position, but it would come down.
If it is you could get some significant gains by doing that.
That's right.
That's right. And that opens up your borrowing serviceability as well, the serviceability as well, right? So if your goal is to be an investor, is that, okay, look, you know what? Okay, maybe we need to take a step back. That's what I said. It's not one formula that fits everyone. Every single situation is different, right? And at KHR Medical, as well as KHR Partners, that because we deal with so many high net worth individual, which is quite complex in a lot of different matters, right? So it's really, really important to have the right level of team around you, right? And with the IFD group as well, with Elisa and Eloise there, Roger there as well, Steve Palisi, Manzurul, and everyone's there, of course, yourself, right? It kind of brings that entire package together for every single individual, all business owners, right? And I think the goal is how we can make your life better at the end of the day, right? How we can improve from where you are and take you to where you want to be.
Yeah. No, that's very well said. I should have said that. So any last words on how, on this topic?
No, I think it's just important to engage all of the professionals in all their different fields to make sure that you're being strategic, as we said, and you're planning ahead and you're not putting all your eggs in one basket and not thinking forward. If your goal is to buy 10 properties, we need to talk about that now and not in 5-10 years time.
Yeah. And not when you're getting on the third or fourth and then you're saying, oh, I can't borrow money anymore. Yeah, that's right.
And we see that a lot, actually. Like especially now we're sort of meeting doctors through the group who haven't had that strategic advice, and they've got all these properties in their individual names and they're completely locked into all of these loans because they can't service. They can't move out of them. So we've seen it quite a lot. So it's good these conversations are coming up, and it's all over TikTok, it's all over social media that people are starting to open up these conversations.
But it's not as easy as they say.
It's not as straightforward and quick and easy as what it's made out to be online.
So it sounds like, the both of you are going to get some phone calls after this, and perhaps there's a way that we can work together to, when you have that conversation.
Absolutely.
We like to have the conversation together. If we're working with the same client, it makes sense.
And we have been doing it with a couple of people as well, right? With few people.
To get on the same meeting.
Yes.
And that saves the borrower from explaining themselves twice. And even if we get the financial planner on at the same call, and the buyer's agent we can all actually come together to work out the strategy in one session as opposed to doing one here and one there and one over here.
Okay, so I'm going to summarize the take home is if you want to have a big property portfolio, have a talk about it today, not wait until you have no more borrowing capacity.
That's right.
Right.
Really have to think about structures early.
Have the right team.
Yeah, to get the right kind of property. That's correct. It's not just about the structuring, it's about the kind of property and the yield for the property.
Especially with the rates where they are. The yield is so important.
Yeah, there's the margin on the yield I find now. Right. It's just sliver thing.
And you know, it's a goal by goal base. Every case is different, but at the end of the day, you know, our job is to try and help the client in the best possible way possible in order for them to reach their goals and objectives as well. And you know, only when naturally as the client grows, we grow with the client, in a sense that, you know, our job becomes a lot more not going to say the word complex, but our job becomes a lot more challenging in order to kind of fulfill their goals and objective as well. And that's what we kind of thrive and we work with as well. So it's very, very exciting problem solving, right? So it's you know, you're working with, you know, every day. And I say that to my team as well, right? You know, sometimes I get like 50, 60 calls in a day, and not every call is exactly the same problem. Everyone has different things, right? And
complicated people have
I don't know if it's a market thing, but you know, it's of course the relationship with an accountant is a relationship based on trust, right? And as you kind of open up with your finances and other things as well, your accountants tend to know a lot more about you than sometimes your own spouse might know.
They probably know more about you than you do.
That's right. So it's a, you know, as you kind of open up and, you know, have that trusted conversation both ways, I think, you know, you can really build a very, very good relationship that is sustainable as with the long-term goal as well.
And not all accountants are like this, and I speak from experience. That the strategic nature of KHI has been, we've been given completely different advice elsewhere, which has been a little detrimental for us. So it's just so important to work with someone who's strategic.
Likewise, Elisa, it's been a pleasure. And I'm sure it's going to be a very, very long road, and looking forward to it all.
Yeah.
Lovely. And that's why we're all here.
Excellent.
Yeah. Thank you for coming today.
Thanks, guys.
Thanks, B. Thanks, Elisa. Good to be here.
Thanks, B.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.